Hi, today is a very interesting and highly unusual way to invest into one of the best companies in the world. That company is Tencent. For those of you who are new, a big welcome to my channel. My videos are about investments that anyone in the world can make. And I mostly talk about public companies that we can all buy shares in, but sometimes I talk about other investing related topics as well. I'm a full-time investor with a decade of investing experience, and I have built a reasonable sized investment portfolio that I'm aiming to continue to grow at 20% per year. One day I actually want to start an investment fund, but until then I'm trying to help as many people as possible understand what they're actually investing in. See, most people spend more time researching their next computer or their phone than they do their next investment. I base a lot of my knowledge on the great investors, Peter Lynch, Warren Buffett, Charlie Munger, Monish Pabrai, and a handful of others. Now, a big thank you today to Pele Nimegan and Gel Visa for bringing this to my attention. Now, although today's video revolves very heavily around Tencent, I have already analyzed them before, and I think they're a great company and I would love to invest in them. I think they have a great culture, a brilliant management team, solid finances, they have good growth potential, and they have strong competitive advantages in multiple areas. But the problem is the current price of around $70 is right on fair value, which means I don't have any margin of safety. I would love to invest, but with a better margin of safety so I can reduce my risk. Under $50 would be far better. But as most of you would agree, that is pretty unlikely to get such a quality company at such a good price. Well, let me explain how there is a backdoor into Tencent that would give us this margin of safety, and that is through the company Naspers. Naspers is an unbelievable venture capital story, surprisingly out of Africa. Naspers originally was a publishing company and started to look at investing in startups to turn more into a venture capital company. But no one could have predicted what happened next. The CEO amazingly discovered an interesting startup in China. Naspers then acquired a 31% stake in this startup company called Tencent in 2001. They paid $32 million for it. In less than 20 years, that has turned into $217 billion. That's over 6,000 times the original investment. It has to be one of the greatest investments of the 21st century. And today, they are still the largest owner of Tencent stock. While Tencent is by far the company's most successful investment, Naspers actually found success with other bets too. In May 2020, it netted a $1.6 billion profit from the sale of its 11% stake in India's e-commerce platform, Flipkart. Naspers first invested in Flipkart back in 2012, I think. And looking forward, well, the Naspers CEO, Bob Van Dijk, said he sees the best investment potential in 3 online areas: food delivery services, mobile payments, and classified ads. And the company makes 90% of its revenue from Brazil, Russia, India, China, and South Africa. And it's looking to those markets for future growth. Now, this isn't just some magical company. There have been a few speed bumps in recent years. Naspers has undergone considerable restructuring, selling lagging businesses and consolidating other ones. Questions have also been raised over the company's remuneration policies. Look, I'll dig into this a little later. But its web and global investments and assets have made Naspers a force in the tech industry. Bob Van Dijk, the CEO, said the key to Naspers' success is in the quality in its employees, which have been lured from companies like PayPal, MasterCard, eBay, Facebook, and Google. He said that we've attracted some of the best in the internet space. Naspers has also benefited from its close ties with Tencent, which gives it a front row seat to innovation in China. The CEO said, "It's really helped us see trends in other parts of the world way ahead of others." Okay, so this is how the Naspers structure works. We have Naspers as the venture capital company, and they recently spun off a company called Prosus, which holds all the international assets outside of South Africa. Prosus is listed on the Amsterdam Stock Exchange. So, Prosus is the company that owns the Tencent stock, but Naspers owns 72% of Prosus. So, think of Prosus like a holding company. Now, Prosus has some very interesting investments, Tencent being the major one, and others you might be familiar with are these. Mail.ru. They own 30% of the major email and social media company in Russia, and that's about a $6 billion company. Udemy, which is an online course company. SimilarWeb, which is a web tool for researching website data. PayU is one of the largest online payment service platforms in the developing world, with a prominent position in 17 countries. Letgo, which is in the United States, which is an app for over with over 75 million downloads that aims to become a top destination for buying and selling unwanted stuff, kind of like an eBay. Then iFood, which is the Brazilian food delivery company, which is the biggest in South America. Swiggy, which is the Indian food delivery startup, which the CEO Van Dyke described as the fastest growing company he's seen in a decade. And then there's, of course, OLX. And it's a massive classifieds website in India, Poland, and Brazil, and it's actually the largest marketplace in those countries. Okay, so the cool thing that we're going to do with this valuation today is that we are going to say all of these assets, except the Tencent stock, are worth $0. Look, some of them are losing money, some of them are making money, and Naspers' net income is all over the place, and so is their free cash flow. Look, it varies from year to year a lot because new investments and opportunities are hard to predict in the venture capital world. Some years they do a lot of investing, some years they don't. But on the positive side, they are not bleeding money, plus current assets are 5 times greater than current liabilities. The debt to equity is very good too, at a 0.23, well below the 0.7 that I'd want to see. So that should be enough from the debt side of things to be happy. Now, all of the other businesses that Prosus has a piece of, as of the last annual report, add up to apparently $20 billion in valuation. But again, we're going to call that zero because most of these companies don't have a clearly defined value like Tencent does on the stock market. See, Tencent is valued at the current share price. So that's really easy to get a hard number. The others are a little bit more subjective. Now, apparently the auditors think they're worth $20 billion, but let's just call it zero to be safe. So, valuing a venture capital company is a bit different to other companies I look at. Generally, what I'm going to do is look at this as an asset play. I'm going to be referring to the net asset value, or NAV. And since we are only bothering to look at Tencent as the only asset, well, NAV is the value of the Tencent shares, which in my opinion is right on fair value right now at $70 a share. So the holding company Prosus, which owns the 31% of the Tencent stock, it actually makes it the largest owner of Tencent too, by the way, is listed on the Amsterdam Stock Exchange and is a spin-off of Naspers. Now this was done to get most of the assets outside of South Africa, as investors were not as interested in a South African company. Naspers is still listed on the South African stock market, but luckily has a listing in the United States as well. Okay, so this is getting all very messy. Let me break it down into steps and just try your best to follow along here. Okay, so Tencent has a current enterprise value of about $700 billion. Prosus, which owns 31% of Tencent, therefore should have an enterprise value roughly of 31% of Tencent. So in a perfect world, it should be $217 billion, which is that 31% of $700 billion. So Prosus should be about $217 billion in enterprise value, but currently it's only $140 billion. So it's actually at about a 35% discount to fair value. So you might be thinking, okay, the discount is fair enough as they are losing money in some of their startup investments and this structure adds just another layer of complexity. But it gets more interesting. See, Prosus being a spin-off of Naspers, well, Naspers owns 72% of it. And Naspers, which owns practically nothing else except some small African cable TV businesses, which hardly affects the financial statements, so we're definitely going to value them at nothing. Now, if Prosus's fair value is supposed to be $217 billion, well, Naspers' enterprise value should be 72% of that $217 billion, which would be $157 billion. Now, since Naspers owns the 72%, we get exposure to all the startups and businesses inside of Prosus as well. And remember, we're assuming they're worth nothing. But Naspers' current enterprise value is only $83 billion, when I think it should be closer to $157 billion. That's a 45% discount to its fair value. So if you bought Prosus shares, you would get about a 35% discount on the Tencent stock. And if you bought Naspers shares, you'd get about a 45% discount on the Tencent stock. Now, based on my initial research and just watching the CEO speak, this is what I found so far. They have a long-term minded CEO. Shareholders have been trying to get the company to sell their stake in Tencent since 2004, but that would have been an absolute disaster. This shows good leadership. Tencent, of course, is just an incredible asset. Now, trying to unlock shareholder value through buybacks is what they're currently planning to do. This is a catalyst that will improve the value on top of the growth of Tencent. At the moment, that 45% gap between price and net asset value has been around for a long time. So this is an attempt to get this a lot closer. I like how they're investing in strong future economies, and most future money has been earmarked to go into India. The company says multiple times that they believe in the entrepreneur that they're investing in and then just let them do their thing. I think that's good leadership too. Now, I think their minimum growth rate will be in line with Tencent's, but they have the potential with all these other ventures and share buybacks to grow faster. And we get a free swing into some incredible startups. Some of them might be multi-billion dollar companies of the future. Okay, gone through all the positives and it seems a little bit too good to be true, so let's see if there are any issues. And after a little Googling, I think I found something, and it's about their management. Naspers' remuneration policy has been criticized in the past for being unclear and over the top. Shareholders and other critics felt executives were largely benefiting from an appreciation in the Naspers share price, which has been mostly driven by Tencent. So, what happened back in 2017 at the annual general meeting was 75% of the shareholders actually voted against the company's remuneration policy. It was an almost unheard of expression of disgust at what was viewed as excessive, unwarranted incentives. Since then, Naspers recently introduced shareholding requirements for the CEO, whereby he or she must hold 10 times their base salary in Naspers shares at all times. And Naspers said that current CEO Bob Van Dijk actually continues to exceed this requirement. They've also made it a lot clearer the link between strategy, performance, and remuneration design and remuneration outcomes as well inside the company. Aileen O'Toole, the Naspers Chief People Officer, had this to say: "We are trying to create a structure that supports and incentivizes the achievement of our business goals while recognizing that we are running a global tech company that is competing with the best in the world for talent. We need to pay for performance, and we are comfortable with giving more to achievers and giving less if not. At the same time, the strategy must be aligned to shareholders' interests. Therefore, we must create a link between this strategy, remuneration, and shareholder outcome." Look, I get it. The company is running a huge venture capital company. It's the largest company in Africa and one of the largest VC firms in the world. What the executives do is very difficult and requires huge amounts of experience and foresight. They travel an awful lot as businesses and opportunities are just scattered throughout the world, and they want to keep these execs in the company because they're doing great work. But I get it from the shareholders' point of view as well. The disparity between CEO's take-home pay and a normal employee would be a Grand Canyon, and no one, especially the media, wants to see the elite get richer, even for good performance. From my opinion, I'm actually happy with the CEO needing 10 times his salary in shares. That is enough for me to say he's incentivized to create shareholder value. I think the other bonuses need to be reined in though. That is something that makes me think why the share price is probably at a discount to NAV, but it shouldn't be 45%. The other negative that keeps coming up in my research is if Tencent goes poorly, well, Prosus and Naspers do poorly as well. They are tied together. We have to treat this as an investment in two companies, and that's just an extra layer of risk. Look, I think this isn't a negative as I want Tencent exposure. All right, let's try to work out what our potential returns will be over the future for Naspers. My discounted cash flow analysis isn't going to work here as it is a venture capital company. What we need to do is look at the growth rates and the NAV. All right, so let's try to estimate some growth rates. So Tencent, I have estimated to continue to grow at about 15% per annum for the next 5 years, which I think is already at the conservative side since they have been growing at 20% for the past 5 years. They are growing in the past 12 months at over 30% and expected to grow over the next year at 25%, but let's be conservative and say 15%. Now, Naspers isn't made up of just Tencent, but let's assume just the Tencent part of this business. So as Tencent grows, so does Prosus and so does Naspers. Okay, so even if the gap between price and NAV doesn't close, we should see about a 15% growth rate from Naspers. That's about the growth I would want from an investment, but I want a margin of safety. I like 50% margin of safety normally with 15% growth rates. So in this case, we want a 50% discount to NAV. So that would mean an enterprise value of Naspers of about $78 billion. And considering the current enterprise value is $83 billion, we are just about right there. But remember, I'm not factoring any of the other assets, so I'm getting a great discount to Tencent, plus exposure to lots of other businesses that could potentially become very profitable. Oh, and the stock market ticker, if you're interested, is NPSNY. This isn't the perfect business, but the downside is low because of the high quality asset that Naspers has in Tencent. If they ever sold their Tencent holdings, I would be out of this. I don't want to invest in a venture capital business. I want to primarily invest in Tencent. I see this as a backdoor with some loaded upside potential. But I don't like the high executive payments, but I can let it slide because they are still heavily invested with 10 times the salary in the stock. And I don't want to see the management team throw good money after bad investments. So still a little digging to do. But I really like that the company holds other assets that I think are really good, and I actually am familiar with a lot of them. I like how they're a venture capital company for emerging markets, and I also like their focus on India. I think India is a fascinating investment area. There are a lot of very smart, gifted entrepreneurs in India, and with a massive population to expand into, I like the Indian market for startups a lot. Plus, we're getting most of this for free. And then there's the share buybacks that might finally be a catalyst for reducing the difference between Tencent and the Naspers NAV. I think if I could, I would much prefer to invest directly in Tencent shares at a 30 to 50% margin of safety, somewhere around $50. But the higher risk option is right here if we really think Tencent is an amazing company and Naspers can do the right thing for their shareholders. This is going to be more of an investment into the management team than anything else. But right now, the Naspers share price is actually really attractive, and I'd want to see that enterprise value under 80 billion, and it's a pretty good deal. Now, I'm going to keep researching this one, and I would love to hear more thoughts on this. I have so many smart people in the audience out there that I'm sure someone has some information to share. Now, don't forget to subscribe to my channel so you don't miss all my interesting upcoming videos, and I will see you next time.